What's up, team? Sean from Rest to Live. And I was getting really prepared to put together a comparative analysis of SoFi versus Nubank versus Ally versus Bank of America, really looking at a number of different metrics, really a number of different measures, things I was paying attention to. And I said to myself, you know what? This is the wrong thing to be showing people who are investing and or maybe relatively new to how to do this. And I'm going to pivot a bit into what I want to talk about today. Before I do so, I would really appreciate hitting that subscribe button. We've been getting pretty good pumps lately in our channel, and just want to say really appreciate that. Secondly, you might notice the camera's a little bit different. Finally got a better camera, which is showing all the white hair in my hair. I can't believe it. I feel so old looking at this. But team, here's the deal. One of the biggest mistakes we can make is misunderstanding the thesis for why we're performing comparative analysis and how our future outlook tied to our thesis needs to drive the result of what we're gearing towards. So I want to cover a couple of the metrics that I think you need to take the time to dig into, no matter who you're comparing in the banking space. But it's very, very important to understand that the future of any position, any equity, any trade you want to make is really derivative in understanding how different comparative analysis will work. In talking about SoFi, we know that they're very heavy in the US. They're having some pretty good growth. They're facing some headwinds like any bank would face. They're a digital first approach, which means they're going to have constant scrutiny from old school banks, from big banks, from too big to fail banks. We know that they're not going to be donating the way a lot of traditional banks are donating, right? Especially on the political side of things. So this can at times create issues. It can create hurdles that we wouldn't expect to see. But there's this sort of ongoing argument I've noticed on Twitter the past few days, really talking about SoFi versus Nubank. And team, I just want to be the first to say, after over 20 years of really being successful in the stock market, you are approaching this the wrong way, trying to compare apples to oranges to bananas to pineapples to crayons to cars to clouds. These are different, completely different types of businesses doing completely different types of things. Okay, and this actually brings in the crypto conversation a bit as well. So I'm not going to spend too much time because I don't want to bore anybody. But what I want to say is this. If you're thinking to yourself, I either want to own SoFi or Nubank, and I really want to make up a decision of which one is better. And if you're asking yourself thinking like, no, SoFi is better, here's why they're better. No, Nubank is better, here's why they're better. Let's take a pause for a second and just think about why these banks are so different. SoFi is very focused on being an everything financial app. Okay, they're a financial services provider. They act as a bank. They have the ability to invest in the stock market, invest in the crypto markets to a lesser extent, but it's still available. They do student loans, personal loans, home loans. They have traditional banking. They are really trying to grow to be that everything app. I have heard through the grapevine that options trading is about to hit the market. I haven't personally confirmed that. Normally, I would confirm that with someone who works there, but I haven't done that yet. So I'm just going to take the word for it for now that that could be coming very soon. She say, okay, well, that sounds great. We're moving towards a digital world. So anyone who is digital first is going to be a potential winner. And I think that's part of the reason why they have grown the way they've grown. Putting the stock price aside, because we're in a very tough macro for everyone right now. So it's hard to look at stock prices being the sole indicator of problems. And there's been some big, hairy conversations on the interwebs and social medias about some of the risk in SoFi, some of the things that may not be foreseen. I just did a video the other day about some of the risks from the crypto perspective. But again, these aren't good or bad. They're just data points in doing comparative analysis of a stock on a decision, right? Not versus another company, but should I invest? Should I not invest? Should I trade? Should I not trade on a particular equity? In this case, SoFi. Then take something like a Nubank. Nubank is not trying to be SoFi currently, right? Nubank is being compared to SoFi, and I asked myself, geez, why is that? Who's even started this comparative analysis? It makes no sense to me. As someone with over 2 decades in this space, I hear these like, which one should I buy, this or that? And I think to myself, like, what? They're not doing the same thing. This doesn't make sense to me, right? Nubank is very much focusing on underserved banking communities, putting banking and some forms of personal credit debt in the hands of their users. Traditionally, in the spaces that Nubank is working, it's where very few other banks were. There is not a lot of entrepreneurial innovation in the banking space. So they're not trying to be an everything app at this point in time. They're trying to just be a banking app for people who traditionally can't get access to banking apps. Okay. So I just want to call this out because there's always this level of confusion, and we're trying to take and compare metric X to metric X, and they're measuring totally different things. And we wonder why it's so difficult to get to a good point here of what to do. What I would urge you to do instead is understand the state of the macroeconomics for banking, split up the different components of the companies that even are comparable. And if you need to, you have to do comparisons. Do it on the one-to-ones, the A to A, the apple to apple. Do not do it on a holistic approach to companies trying to be totally different things. It doesn't help you be a better investor. It doesn't help you make better investment decisions. Now, if you think, for instance, that there's more traditional banks and you want to compare those to a SoFi, or there's more international style banks and you want to compare that to a nubank, I can see the play there because you want to understand what kind of a market cap or what kind of a total addressable market could they potentially pull from and steal from those bigger players. That makes sense to me. That's a growth story. That's something I can get behind. But comparing two players who are trying to solve for different problems in different areas of the world, I feel like that's a waste of time. The other thing I want to call out here too, because I've noticed some really significant incorrect approaches to trading and investing recently. And I don't pretend that I know everything. It's far, far from that. But when I look at the most successful traders I know, people who have 50, 100, $200 million net worths, who have been doing this for far longer than I, when they hear things like buy on the down days, sell on the up days, they just shake their heads. One thing you have to really get yourself around here when you're thinking about holding positions like these, because let's call it what it is, these are growth companies. They're in the early stages of becoming what they will be. So you have to have a thesis for where you think they're going. You have to have a directionality into where you think they're going to end up. But if you're approaching this from a trading perspective, you are really going to have to learn to love the trend when it comes to these kinds of growth companies in the kind of macro environment we are in. This means you do not want to start buying in when things are still going down. That makes no sense. You don't buy something that's going to lose you money. If you see continued pressure on the downside, play it for the downside. If you start to see a turnaround, who cares if you miss absolute bottom, as long as you're in at the right time. If you think that things are changing and we're going to start to go to an upswing, let the upswing start to happen, get conviction and confirmation in the turn of events, and then take the positions you want to take to ride that as far as you possibly can, and learn to have a strategy for when you execute, how you set your trails, and how you set your stop losses. Once you understand how to do all of that, the original research is going to help to embolden your positioning. The intermittent technical analysis you're doing is going to help with those entries and exits. And then the long trail understanding of the trends will help to drive those huge profits. Now, I want to share real quick 10 things that I personally look at. And these are some of these you will have heard before, some of you will not. And what I did is I wrote down I took little notes on a Post-it note just because I want to go through this really quick of 10 little areas that I like to look at. And then just a quick, brief definition in my own mind of how I think about them so I don't forget them. And this is where I would really start to do, if I'm going to do comparative analysis of an apple to an apple, or if there's a division that is very similar to another division, and I want to just look at those pieces of the bank, I'll use it for those as well. I'm going to go pretty quick here. And I'm happy to go deeper onto any of these. If there's comments about it, or if you have additional questions, I'll be happy to answer in the comments below. But let's blow through this real quick because I know that time can be tight. The number one thing I'm looking at is net interest margin, right? This shows a bank's net profit on interest earning assets. Think loans, securities, etc. And this often will show us an overall profitability of the bank, okay? The next big one I'm looking at is return on assets. So this indicates the per dollar profit a company earns on its assets. But a big call out here, team, this is a mistake a lot of people make. It does not measure risk, okay? So keep that in mind. We don't just want to know how great things can be. We want to also know how bad could they get. The other piece of it is return on equity. This is a two-part measure of financial performance that brings together the income statement and the balance sheet. And our overarching reason for looking at return on equity is we want to have some sort of a gauge of a bank's profitability and efficiency in generating profits, right? How good are they at doing it and how good are those profits? The other one I take a look at is loan to assets ratio. So this is really taking a step back and looking at the overall operations of a bank. And it helps us to understand where income is really coming in from, right? Is it coming from one area or another, one type of asset or another, one type of portfolio or another? It's really important to get a feel for this, right? It's not just about numbers in a bank. Banks need to have consistent views of operational excellence, efficiency, operational components that you don't think of in other types of companies. So just important to know these and know them pretty easily. The other one, and this is going to be a mouthful, is a risk-adjusted return on capital. Okay, it's a risk-based measure of profitability. You might have heard me say earlier, we're not looking at risk. Well, now we are. So this allows banks to more accurately compare products and portfolios of varied sizes and makeup. The real takeaway of this is that ultimately it helps banks decide what products they want to promote internally. Is it the new mortgage? Is it a new product they're going to sell? Is it bonds? Is it a new savings account? Is it free checking or not, right? They need to know what the long tail profitability will be when you include the risk. The risk might be that it doesn't generate any kind of interest-bearing return. Well, does it generate other types of business off of it, right? So having the ability to do this and look at that is a great measure of how well banks are doing this, because no matter how exciting a growth stock might seem in the banking space, if it's not making money in an efficient way, that growth is going to be hampered at some point, which means raising more shares, which means dilution for you. It means having to get more risky in the things they're offering, which produces, potentially better returns, but bigger risk of losing your money. So let's jump back in. Another one is efficiency ratio. So this is measured by dividing non-interest expenses by revenue. And the goal here, really and truly, it's going to be obvious when I say it, but it really helps them determine things like staffing, right? How many people do they need at a branch if they have them? If it's an online bank, how are they hiring for those different positions they have? So how efficiently are they running their business, considering that most of the revenue comes in through very few sources? Another one here is loans to deposits ratio. Now, this is particularly important whether it's a bank on the corner or a bank up in the cloud, right? It measures a bank's liquidity or ability to cover loan losses, and withdrawals. And ultimately, it's our measurement as an investor to look at how efficient management is at the institution. So loans to deposits ratio, I don't hear this ever talked about, but I'm telling you, this is one that I particularly want to keep my eye on when I'm looking at these types of investments. Another big one, and there's only a few more to go here, yield on loans. Yield indicates the net profit a bank earns on investments that includes both interest and dividends on those investments, okay? So that's yield on loans. Excuse me. Only two more. Allowance for loan and lease losses to loans. Okay, it's a mouthful, but again, it's important. And I would urge you to do your own research on these as well. This reflects the estimated credit losses within a bank's portfolio of loans. There's some big battles going on talking about Sofi on Twitter and YouTube right now about whether or not there's risk that's been unforeseen, if these loans are getting too risky, if the credit profiles are not as good as they're claiming to be. So the truth is, it kind of doesn't matter. As long as we know what the allowance for loan and lease losses to loans is, we'll know, could they survive a huge problem in lending? If people started to not pay their bills, if loans were getting defaulted on, it's only a concern if they're not prepared for it. And this is the thing that makes banking so unique. You're giving out money knowing you're not going to get some of it back. This is why we look at measurements like this so differently than any other. And the absolute final one here is cost of total deposits. This looks at the cost of deposits with an eye on non-interest expenses and income. If you're thinking that sounds confusing, I'm going to give you a perfect example. If I do my banking at any bank ABC, and I can open up a checking and a savings account that costs me $0 per month, okay? And that's all I do at that bank. They need to bring that into account of the total deposit costs, because what if more and more customers use their bank but don't generate any kind of income for the bank? We have to build that into the overall picture, because deposits are not always going to be interest bearing for the bank. They're not always going to be enough to really make it worth loaning that money out. Maybe they have a $1,500 minimum, but does that cover the cost of managing my account, sending me in a letter every month, having me on an email list? There's cost to all of that. So I just want to call a couple of these things out, because I think that a lot of times the battles between stock symbols and financial YouTubers and Twitter folks, team, this doesn't have to be complicated. That's the point I'm making. I could live inside of a cave, never go online or on social media, but as long as I can get these metrics, I can effectively measure where I want to potentially invest my money. So with that, thanks so much for watching. I hope this was valuable. I do try to approach this in ways that other people aren't doing, rather than just do a simple compare of A, B, and C. So let me know what you think. Let me know if you've heard of these things before, and if there's any particular metric you'd like a better example on, how to find it, where to find it. I'm more than happy to help talk through that. So please drop it in the comments below. Hit that like button if you're still here. And do me a favor. Do you like SoFi, nubank, traditional banking? Who are you looking at in the banking space? Thanks so much, team. Have a great day. And honestly, really appreciate everyone who watches. Thanks so much, team. We'll see you.